The mechanics of the $55 floor. Why a Hormuz ceasefire will trigger a prolonged oil crash. July 23, 2026. When geopolitical tension in the Strait of Hormuz breaks, headline readers naturally expect energy prices to cool down. What fewer appreciate is the sheer violent velocity of that unwinding. Prior to the current strait drama, the market still appeared to be moving to a gradual multi-quarter decline and remaining relatively stable in its fluctuations. But behind today's elevated spot prices sits a market held up by a dam of physical obstruction. The moment a durable ceasefire or maritime memorandum opens the strait, the dam dissolves. What follows is not a gentle slide, but a structural market reset that threatens to push West Texas Intermediate crude down toward or below $55 a barrel and lock it there for 3 to 6 months or longer. Understanding why requires stepping past political headlines and examining the 4 financial and physical gears driving commodity markets. 1. The evaporation of paper market war risk. Oil prices exist in 2 places: the paper market, where traders exchange financial futures contracts, and the physical market, where actual barrels change hands. During active conflict, paper markets bolt on an aggressive geopolitical risk premium, often $20 to $25 per barrel, to hedge against potential supply destruction or blocked shipping lanes. Financial algorithms and institutional trading desks do not wait for the first tanker to pass through a cleared choke point to adjust their positions. The moment news confirms a signed, verified ceasefire, algorithmic trading programs liquidate long geopolitical hedges instantly. As demonstrated during the brief June peace talks, paper markets can shed $15 to $20 in a matter of days simply by stripping out the fear factor before a single new barrel moves. 2. Why the price drop lasts, from scarcity premium to storage glut. To understand why oil prices are likely to stay low after a ceasefire rather than rebound quickly, look at the shape of the futures curve. The difference between the price of oil for immediate delivery and the price of delivery months later. During the conflict, current situation, near-term oil trades at big premium over later delivery oil. This is called backwardation. Buyers are willing to pay high prices right now because they fear they might not get physical oil tomorrow. The market is pricing in scarcity and risk. After a durable ceasefire and the strait reopens, physical oil suddenly floods back onto the market. The curve flips into contango. Now the opposite happens. Oil available today becomes cheaper than oil for future delivery. Prompt crude might sit around $55, while later contracts remain higher, for example near $65. In a contango market, buyers have little incentive to pay high spot prices. Extra oil has to be stored, and storage costs money: tank rental, financing, insurance. As a result, the market stays under pressure for much longer than most people expect. A simple way to remember it is backwardation is fear of running out, high prices now. Contango equals too much oil sitting around, low prices now, and they tend to stay low. When a major supply shock ends and the curve flips into contango, history shows prices often remain depressed well beyond the initial relief rally. 3. The dual physical influx. Tanker dumps meet restarted wells. The paper market collapse is only the appetizer. The physical wave is the main course. Once transit clears, 2 distinct physical supply shocks hit refiners simultaneously. The floating storage wave. An estimated 200 to 240 million barrels of crude are currently trapped on water, sitting in idling very large crude containers, dark fleet vessels, and regional Gulf anchorages. This stranded inventory will race to unload at Asian and European refining hubs to minimize daily vessel charter fees. Unchoking shut-in production. Because onshore storage in Saudi Arabia, Iraq, Kuwait, and the UAE filled to capacity during the blockade, state producers had to shut in 8 to 10 million barrels per day of wellhead production. Unlike drilling a new shale well, turning existing valves back on takes weeks, not years. When over 200 million barrels of floating storage hit refiners at the exact same time 8+ million daily barrels of turned-off production come back online, physical spot markets experience a severe immediate oversupply. 4. Why the $55 floor will persist for 3 to 6 or more months. A common misconception is that once prices drop, OPEC plus or natural demand will swiftly pull crude back up to $70 or $80. Technical and macroeconomic factors suggest otherwise. The baseline oversupply. Before the strait was choked, global supply was already outstripping demand by roughly 2 to 3 million barrels per day due to expanding non-OPEC production. U.S., Guyana, Brazil. The conflict merely hid the underlying glut. Demand hysteresis. Months of high energy costs during the blockade forced global refiners to cut run rates and accelerated industrial fuel substitution. Global demand growth remains sluggish at 1.1 million barrels per day. Demand recovers at a walk, while physical supply returns at a sprint. Inventory digestion. Global commercial inventories, severely drawn down during the crisis, will take 3 to 6 months or more to refill. Until land-based storage and strategic reserves reach equilibrium, spot crude cannot command a premium. The bottom line. The high oil prices seen during a Middle Eastern maritime crisis are an optical illusion created by an artificial barrier. When the back-channel negotiators in Muscat and Islamabad finally lock in a truce, they won't just be signing a peace agreement, they will be pulling the plug on the geopolitical risk premium. As paper traders liquidate, floating tankers unload, and choked wells unfreeze into an already oversupplied global economy, oil prices testing $55 a barrel isn't just a possibility. It is a structural market necessity that will likely define the energy landscape for the remainder of the year and possibly beyond. Eyes open. The Mercer Ledger is an independent, reader-supported platform. You can back our work at ko-fi.com/WEMercer. That's ko-fi.com/WEMERCER. And thanks for listening.